right. Leona, do you want to go ahead and get us started?
Hello, everybody. Thank you for joining us today. I'm Leona Perry, Events and Programs Manager with Greater Spokane Incorporated. I know GSI as well as DSHS, the business community, and the Washington Care Fund is very excited to have you here today, especially as we prepare for long-term implementation. I want to take the time to thank all of you for coming and participating in today's webinar. I know we all look forward to your questions and comments at the end. And yes, just thank you for not only participating, but taking the time out of your busy schedules. We know this is going to be exciting and fun. And I say fun because I'm saying that with positivity. And I just thank you that you're here. I'm going to hand it off to Kristen Mackey with DSHS right now.
Hey, everyone. My name is Kristen Mackey. I'm the Community Relations and Outreach Program Manager for WaCares Fund at DSHS. And here with me from our WaCares team, we have Veghte, who is the Director of the WaCares Fund at DSHS, and Alison Eldridge, Transformation Manager at ESD. We're so glad to have you joining us today. And I'm going to go ahead and hand it to Ben to get started.
Thank you so much, Kristen. So thank you everyone for joining us today to learn more about WaCares. Let's start by defining what we're talking about when we say long-term care or caregiving. Long-term care is help with activities of daily living like bathing, dressing, preparing meals, grocery shopping, and more. It is not medical care like doctor's visits and treatment for medical conditions. Long-term care covers a broad spectrum of needs and circumstances, including for younger people who may have unexpectedly experienced an injury or an illness that requires them to get supports in order to be able to live independently. A lot of people don't realize what a broad range of services can be included when we talk about long-term care. We often think of it as care in a residential setting like a nursing home or assisted living facility, but it can also include care in your own home. In fact, the vast majority of people can stay in their own home when they need long-term care if they have the right supports in place. And polling shows that most people prefer to stay in their own home. It's also very common for family caregivers to not realize they are a caregiver. You might go to your mom's house a couple of times a week to cook meals, drive her to appointments, and make sure she's taken her meds, which are all common care activities. In fact, the majority of this type of care is provided on an informal basis, unpaid care from a family member, friend, or neighbor. Next slide. Here's how the WaCares Fund can help. WaCares is a universal long-term care program in Washington State. It's an earned benefit. You contribute for a certain number of years to qualify for benefits. It's self-funded from worker contributions, which go into a dedicated trust fund only used for this program. Almost all Washington workers contribute. Some workers are automatically not included. So federal employees, for example, are not included. Tribal business employers are only included if the tribe is opted in. And self-employed people can opt in. Other groups of workers may be able to apply for an exemption. Alison will talk more about that later on. Workers contribute about 0.5% of their wages to WaCares. So it's 0.58% of every paycheck goes to WaCares. You can see here what this looks like for the typical worker who makes just over $50,000 a year and would contribute $291 a year, or about $24 a month. You only contribute while you're working. Contributions stop when you retire or if you become unemployed. Everyone is covered at the same rate regardless of pre-existing conditions. And when it comes to claiming your benefits, there are no copays, no deductibles, and you never need to file a claim. We connect you with contracted providers for the services you may want, and we pay them directly on your behalf. Contributions to the program begin next month, and benefits will become available in 2026. Next slide. This is what contributions look like over the course of a career. You see in the middle column here, the typical or median worker covered by WaCares, what they earn. And you can see that $290 in contributions each year totals to $8,700 over 30 years. And in return, you get a $36,500 benefit that goes up with inflation even after you stop working. So it's a great deal for the median worker. It's also a great deal for most workers. Even if you make 4 times the median wage, if you make $200,000 a year and you pay in for 30 years, you're still getting back more in benefits than you've paid in. Next slide. Everyone contributing to the Walk Years Fund more than 400 hours per year is earning benefits, part-time and temporary workers included. By contributing for a certain number of years, you earn qualifying years towards the $36,500 benefit. There's 3 pathways to meeting the contribution requirement. First, on the left, you see the early access pathway for workers who have not yet earned lifetime access, but have a care need while working or soon after leaving work. So, for example, if I'm a 30-year-old and I've been paying in, and it's 5 years from now, and I've been paying in at least 3 years on the last 6, and I have a ski accident or a motorcycle accident, I could claim my Walk Years benefits while I'm recovering. The middle column here is for lifetime access. This is the standard pathway that over time most people will use to qualify for their benefits. It's the same pathway that Social Security and Medicare have, where you contribute 10 years without a break of 5 or more years. So you contribute 10 years over the course of your career. And on the right, we see a new pathway that was enacted in 2022 by the legislature. And this is for people who are close to retirement, who might not be able to meet that 10-year pathway. And for them, if you're born before 1968, which means you're roughly 55 or over today, and you say you retire 4 years from now, and you pay in 4 years into Walk Years, you would earn permanent access to 4 times 10% or 40% of the lifetime benefit. So that would be around $14,000 in long-term care benefits. Another example, you could work 500 hours after contributions start this July and retire at the end of 2023, the end of this year. And as long as you worked 500 hours during that time, you would have earned 1 earnings year credit towards benefits, which means you would qualify for 10% of the lifetime benefit, or $3,650. Near retirees will have permanent access to whatever percentage of the benefit amount they earn at any time they need care. They're also able to qualify through the other 2 pathways. So if you're born before 1968, but you end up working 10 years, you would be eligible for the full benefit. Next slide. So once workers meet contribution requirements and need help with at least 3 activities of daily living, they get access to a $36,500 budget for services and supports. And that increases with inflation. You can use that budget flexibly on whatever kind of long-term care you want. We are trying to empower, the program is designed to empower families to cope with the crisis of long-term care when it strikes. So if someone is paid into Walk Years, qualified for benefits, they get their benefits, you can use it to make a family member a paid caregiver, a son or a daughter or a spouse could become a paid caregiver, or you could hire a professional home care aide, or you could get respite services for a loved one who's caring for you so they can get a break once in a while and bring in delivered meals, for example, to support them, maybe bring in a home care aide just a few hours a week for bathing purposes, for example. But other than that, maybe a family member takes care of you. That would stretch your benefit for multiple years. Or you could do 20 hours of home care for a year and use up your benefit quicker, but have full home care support. You can also use it to go to a facility if you want. You can go to an adult family home or a nursing home, but you'll stretch your benefit much further if you use it to age in place in your own home. Next slide. We get asked a lot about what the benefit can be used for and how long it can be used for. It's important to keep in mind that most long-term care is not utilized for a long period of time. Usually it's towards the end of life and it's for a short period of time. About 1/3 of people need long-term care for a year or less. And for those people, Walk Years, for most of those people, Walk Years can meet all of their needs, all of their long-term care needs. For a second third of people, they need care for 1 to 3 years. And for them, if they stretch the benefit by combining the Walk Years benefit with unpaid family caregiving and maybe using some of their own savings, or maybe some of their kids can kick in with financial help, you should still be able to stay in your own home throughout your entire care trajectory and never have to apply for Medicaid or go to a nursing home, for example. And then for the final third of people who need long-term care, they need it for more than 3 years. And for those people, they'll probably exhaust their Walk Years benefits and end up using their own resources, or if they don't have savings, going on Medicaid. And with that, I'll pass it to my colleague, Alison Eldridge from the Employment Security Department to talk more about the employer role and about exemptions.
Yeah, thank you, Ben. So the overview of employer responsibilities for WellCare's Fund includes managing exemptions from their employees, withholding premiums, and reporting and paying quarterly to Employment Security Department. Employers don't have a share of the premium, but they will maintain records of exempt employees, collect premiums from employees beginning July 1st, and report employee hours and wages and remit premiums to ESD. We wanted to keep this as similar to paid family and medical leave as we could for the employer experience portion. So the definitions of employer, employee, and remuneration are consistent across the two programs. The definition of wages is also the same. The one difference there is that in WellCare's Fund, the Social Security tax cap does not apply. Next slide. So we'll start with exemptions. And first, there are two kind of pathways that are a little, well, there's more than two, but we'll talk about that. There's original exemptions, which were for people who had private long-term care insurance before November 1st, 2021. The applications for those exemptions were accepted from October 1st, 2021 through December 31st, 2022. That application is no longer available, but people who were approved for one of those exemptions and have their approval letter from ESD are still permanently exempt. Next slide. There are additional exemption pathways that were added as of January 1st. Those are for, there's 4 categories. There's veterans with a 70% or greater service-connected disability, non-immigrant visa holders, spouses and registered domestic partners of active duty service members, and out-of-state residents. The service-connected disability exemption is similar to the original long-term care insurance exemption in that it is permanent. The other 3 are conditional. So if a person meets the conditions of the exemption, they can be exempt. And when they no longer meet, if they no longer meet those conditions, they need to inform both their employer and ESD that they are no longer exempt from paying premiums for WellCare's Fund. The application process, each exemption type requires documentation. They all require identity documents and then different documentation depending on the exemption type. So folks who wanted an exemption, we need to create an account and have their documentation ready. The details and instructions are available online at WellCare's Fund on the exemptions page. Exemption applications submitted after June 1st, 2023 may not be approved and effective before premium collection begins, but we are doing our very best to process every application that we receive before July to make sure that folks have their exemption in place before premium withholding begins. Next slide. So for the employer side of exemptions, it is the employee's responsibility to apply for and, if approved, to give a copy of that approval letter to all current and future employers. Once an employer is notified that an employee has an approved exemption, they need to keep a copy of that exemption letter on file, and they must not deduct WellCare's premiums from those employees. And there is an example of an approval letter. You'll see that it has an effective start date. So typically, the start date would be the quarter following the approval of the exemption. Next slide. For premium withholding that begins July 1st, we do have a premium calculator on the website. And so individuals who are curious how much they'll pay can use it. Employers can also use it. The calculation, the premium is 0.58% of an employee's gross wages. Again, the definition of wages is the same as with paid family and medical leave, except that the Social Security tax does not apply to Walk Care's Fund. Next slide. Quarterly reporting for Walk Care's Fund will begin on October 1st. It is a combined wage report for Walk Care's and paid family and medical leave. So employers who have been reporting for paid leave can use the same account. It's the same report. It's all together. There are new reporting requirements that will apply to both programs. So in general, for the report, we need the UBI number, business name, the total paid leave premiums collected, total Walk Care's premiums collected, and then for each individual employee, their SSN or ITIN, first and last name, an indication of their exemption status if they have provided their approved exemption letter, and then their wages paid and associated hours worked. We have also added the employee date of birth to the wage report and a requirement that employers report even in quarters when they do not have payroll. Next slide. So this should look familiar for anyone who has used the reporting for paid family and medical leave. There's two different, for employers, there's two different reporting methods. You can report manually and individually enter up to 50 employees, or upload a CSV file. And we will have a template for that file and file specifications online on August 1st. If you have a CPA, that's another pathway to reporting and paying for both programs at once. And typically a CPA would report with an ISESA file or with a file upload. Next slide. The payments is the one place where it's a little different between the two programs because they are two distinct funds. The payments do need to be made separately. We've tried to combine it into as seamless a flow and experience for employers as possible to reduce extra work. But the payments are separate, but you'll make them through the same account, same pathway, same at the same time. Next slide. So because we know that there's a lot of different aspects to employer requirements and folks have a lot of very specific questions, our employer reporting team is hosting a series of webinars, generally 2 a month through the end of the year. And so we have different topics that go into greater detail, and we will have them posted on the website, but we also are including information and links to register in our employer newsletter. Back to you.
Thanks, Alison. Next, we know you're getting a lot of questions from workers about Walk Cares and want to make sure you have what you need to answer them. Here's an overview of some resources that are available in our employer toolkit at walkcaresfund.wa.gov/toolkit. Again, walkcaresfund.wa.gov/toolkit. These materials are designed for employers and other organizations who want to communicate about Walk Cares. Many of these materials are available in multiple languages if you have large numbers of employees whose primary language is not English. Next slide. First, we have a calendar with major milestones and recommendations that makes it easy for employers to communicate with employees about the program. It gives you a template for when and how to deploy all of the toolkit materials to ensure your workers are well informed. This includes a paycheck insert you can use either electronically or place in printed pay stubs. There's an FAQ document that covers a wide range of questions you may be getting from employees. We'll continue updating this document as we hear about new questions that are coming up often. We also have monthly long content designed for you to use in all staff emails, mailing list updates, or intranet posts. The content for each month is tailored to what employees need to know at that time. We respect that you have to communicate about a broad range of issues with your employees, and so we tried to make this as sort of cut and paste and as easy as possible. Next slide. We have a few other materials like social media content that are primarily designed for community organizations but includes simple graphics you may find useful for including in an employee newsletter or other materials. Next slide. We have a fact sheet and poster available in English plus 15 other languages. We recommend putting the poster up in your break room and including the fact sheet in employee benefit packets provided to new employees. We also have an infographic with a visual overview of the program. Next slide. We have a wide range of video content available, including animated explainer videos, program overview videos, and recordings of past webinars covering program basics. We are also working on a series of FAQ videos that we hope to publish very soon, covering program basics, like who contributes and how you can use benefits. Next slide. You can sign up for our mailing list to be notified when new materials like those FAQ videos become available and to receive other program news and updates on webinars. And ESD has a fantastic employer newsletter that provides monthly updates on WACARES, along with info on other programs like paid leave and unemployment insurance. You can find links to subscribe on the Toolkit page. Back to you, Kristen.
All right, thank you both for that. We are going to go ahead and move into the Q&A portion of today's webinar. If you have questions and haven't already, please use the Q&A button on your screen to enter your question for our panelists, and we will go through and read those out. I want to start by answering a question that we're hearing from several people, which is when and where will you be able to find the slides and the recording of today's webinar? That is available in the chat, the link both to the WACARES website as well as to the GSI website, where you'll be able to find all of those materials. So then our first question, we have someone asking, when a team member is on a leave of absence, does the contribution stop while they're on a leave of absence? And how long does it take for a team member to receive an approved exemption letter if they qualify?
So on a leave of absence, it would depend on their circumstances. If they're being paid and have wages to report, or if to withhold from, it would be a different answer than for someone who is not in that circumstance. So I would suggest calling our customer care team to kind of talk through the specifics of that individual. For the question on how long does it take to get the approval for the exemption, it's typically pretty quick. I will say that at the current moment, we have seen an uptick in the number of folks who are applying for exemptions leading up to premium withholding. We are working through them as quickly as we can, and we are committed to getting them approved by July 1st. It also depends on whether a person provides all of the information that is required in the application for the exemption. So complete applications will take less time than incomplete applications, but we do reach out to the person who submitted in all cases, and if we don't have what we need, we'll work with them to get it rather than deny the exemption.
Thank you. We've got someone asking, what if someone works in a different state but lives in Washington? Will they be a participant in the program?
So if their work is not localized to Washington, they would not be. Generally, if they are, if you're currently reporting and paying for paid family medical leave for them, the same localization rules would apply for WACARES funds.
All right. And if someone, a worker has paid into WACARES and ends up qualifying for an exemption later, will they get a refund for the amount paid into WACARES?
No.
Thank you. Ben, this is a question for you for some clarification on the near retiree pathway. So you mentioned that if you're born before 1968 and contribute for 4 years, you would get 40% of the benefit amount, but doesn't that pass the 3 of 6 years requirement? So you would get the full benefit, and whether once you work 3 of 6, are you qualified for life?
Great question. So the 3 of 6 is a temporary access pathway. So that's only at the time you apply, there's a look back to say, have you paid in 3 out of the past 6 years? If you have, then you can get the full benefit. But once you've stopped working for 4 years, you no longer satisfy that requirement because you would no longer have paid in 3 out of the last 6. So if you retire, once you're 4 years into retirement, you no longer would be able to meet that 3 out of the last 6 years. So the reason for the near retiree pathway is, so let's say I work 4 years and then retire, and then 20 years from now I need long-term care, that I have permanent access to that partial prorated benefit. Whereas for the 3 out of the last 6 years pathway, that's only a temporary access pathway. So that's a full benefit, but only available for a couple of years beyond retirement.
Thank you, Ben. We've also got someone asking whether there is a monthly maximum of the benefit amount that you can spend.
There is no monthly maximum. In a very early version of the legislation, there had been a daily maximum, but that was dropped before the bill was enacted. So I know there's been some confusion around that, but there are no limits on how much you can utilize per day or per month.
Thank you. And here's one for Alison. If an employee received an exemption letter from ESD and therefore is exempt from premium deductions, would they be allowed to enter into WellCares if they should lose the private insurance policy that made them exempt?
Not for the private insurance exemption. So the private insurance exemption and the exemption for veterans with a 70% or greater service-connected disability are permanent. The other 3 exemption types, the non-immigrant visa, out-of-state worker, or out-of-state resident, and spouses and registered domestic partners of military members, those are conditional, such that if someone no longer meets those conditions, they would be back in to WellCares.
Thank you. And Ben, we've got someone asking, is WellCares the first benefit provider, or do other types of benefits have to be exhausted before you can claim WellCares benefits?
You can use WellCares however and whenever you want once you've earned the benefit and qualified. So it works more like Medicare or Social Security. It's an earned benefit, and there are no requirements that it be a payer of last resort. That's true for Medicaid because it's a means tested benefit, but because you've earned this benefit and paid in, you can use it however and whenever you want.
Thank you. And we've got someone asking, does beginning July 1st, 2023 mean any paycheck paid on or after July 1st, or any pay period beginning on or after July 1st?
So let me get the wording exactly right. I wrote it down just in case. It is on as paid, not as earned on the wages.
Thank you.
So it's whenever they're paid. Yeah.
All right. And then we've got someone asking for employees who currently live out of state and are going to relocate to Washington and didn't have an opportunity to apply for private insurance. What options do they have for an exemption?
So they would have the same options if they met any of the other categories of exemptions that is available. They would have the opportunity to apply in one of those. And if they don't, at this time, there's no other pathway.
Yeah, the idea there is that this is a universal program. It's supposed to be kind of like Social Security or Medicare. And initially, there was a grandfathering in of people who had private insurance coverage prior to November of 2021. But going forward, everyone in the state is going to be covered, except for these conditional exemption, except for these categories that Alison mentioned, which are discrete groups of people and fairly small groups of people. But for the vast majority of people, are whether when you move to the state or when you mature into the workforce, everyone's going to be covered.
Yeah. And then we've got several folks asking about what kind of counts as a qualifying year, whether that is a calendar year for this first year, since it starts July 1st. Is it 500 hours that you need to get between July 1st and the 31st to get that qualifying year?
I'm going to take that one, Alison, and I can take it if you'd like. Yeah, so for the first half year counts as a full year, right, Alison? And then going forward in perpetuity, it's going to be every calendar year counts as a full year. It was kind of awkward that the program starts in the middle of a year, but to make it intuitive for people over the long term to look back and remember how many years they paid in, I think we thought calendar years just made more sense, so that going forward, 10 years from now, you'll remember when you worked and how many years you paid in and so forth.
Thank you. And then we've got someone asking, if I have canceled my private long-term care policy and got an exemption, will I ever be audited that I did not maintain private coverage?
I could take this, Alison, because it's kind of a commission question. So under current law, no, you have your exemption, you have it, it's permanent. But it's important to know that our oversight body, the LTSS Trust Commission, did recommend to the legislature last year that people do need to recertify their coverage every few years. The legislature didn't take up that recommendation in the past legislative session, but they might take it up in the future. They might not take it up in the future. We can never predict what the legislature will do, but I just thought you should know that that was something that's, it's certainly, it could happen in the future, but current law is that once you have an exemption, it's a permanent lifetime exemption.
Thank you. All right, we've got someone asking, we have employees that are from out of state that only work for 3 months out of the year for us. Do we take these contributions from them as well?
If their work is localized to Washington at the time that they are working for you, then it would apply. If they live out of state and would qualify for an out-of-state exemption, they could apply for one and be exempt.
Thank you. And kind of related question, if our company is in Washington state, but an employee works remotely from Nevada, are they automatically exempt or do they need to apply for an exemption? And if they apply for an exemption, then move back to Washington at a later date, do they apply to become no longer exempt?
So if a person, regardless of where they live, if their work is localized to Washington, they would be included. And you could call the customer care team, would be able to walk you through specific circumstances. If a person had an out-of-state exemption that was approved and then moved to the state, they would need to notify their employer and ESD within 90 days of the change in their condition that qualified them for the exemption, so that they would begin paying the premium and be included in the program.
Yeah. If a new employee starts and brings us their exemption after a few payroll cycles, their gross wages will be different for paid leave and walk cares. Where do employers note that difference?
So their gross wages would be the same, but their exemption would have started mid-quarter. I think if I'm understanding the question correctly, we are working on some updated guidance for employers for what to do in those circumstances. We know that employees are not always going to give the letter to their employer as soon as they get it. They may change employers, things like that. So we will have updated guidance for employers that will be sharing through the newsletter and on the website in the near future.
Thank you. And we've got someone asking, we have employees who currently are in an active collective bargaining agreement. Are they exempt from contributing until the CBA is open again?
Let me get the date right. Let me pull up the law. So if a collective bargaining agreement was in existence on October 19th, 2017, and has not been reopened, renegotiated, or expired, that's the date to look at. So if they fit that circumstance, they're covered by a CBA that hasn't been reopened, renegotiated, or expired, and the agreement existed October 19th, 2017, then they would not be.
Thank you. And we've got someone asking, if your payroll provider files these on your behalf, is there any action for the employer to submit the contributions or data?
If you have a TPA, you would likely want to check with them to make sure that they're up to speed. We have been working with the National Consortium of Payroll Providers, so we definitely have communicated with them and given them all of the information they need. My understanding is they're fairly well up to speed on what has to happen, but probably wouldn't hurt for you to check in with your specific provider and check.
All right. And Ben, one for you. Does someone need to live in Washington State in order to use the benefits? And if they live in Washington and contribute, then move to a different state, are they still entitled to use benefits?
Great question. So under current law, you have to live in Washington to use the benefits. But again, our oversight body, the LTSS Trust Commission, made a recommendation to the legislature last year to allow people who pay in at least 1 year and then leave the state to continue participating in walk cares and use their benefits in other states. The legislature didn't open the statute this past session, but that there is a strong interest in making benefits portable in the legislature. We can't get ahead of that. We have no idea, whether they will enact that, but it's something that's definitely on their radar. If that's something that's of interest to you, I would encourage you to reach out to your legislator and flag that interest. But it's under current law, you have to be in Washington State in order to use your benefits.
Thank you. And we've got someone asking, as an employee, if I need to reprint an exemption approval letter, can I find that online or request it?
Yeah, in 95% of cases, it will be in your exemption account online. If for some reason it isn't, and that could be, there are some folks who needed corrected letters. There's just a handful of scenarios. If someone applied on paper for some reason or needed a reasonable accommodation, you can always call our customer care team and they'd be able to get you a copy of the letter. But for most people, you should be able to log in through your exemption account and download and print a copy of your letter.
Is there, Alison, is there like a web address or something for folks to go or for that? I mean, people probably remember where they went initially, but just to make it clear.
Yeah, so you log in through Secure Access Washington. So you go to secureaccess.wa.gov and then log in through your SAW account. If for some reason you have multiple SAW accounts and can't figure out which one is the right one, there is on the SAW page, there's a way to get help with that to try to figure out which account you may need to use. And you can also call our customer care team and they can walk you through that.
Thank you. And we've got someone asking if an employee is part-time and also has a full-time employer, do all employers for a worker need to deduct from their wages?
Yes.
All right. It looks like we could use a little bit more clarification on the near retiree pathway. We've got someone asking, previously information provided indicated employees who are close to retirement did not have to participate. Is that still true?
So that was never the case that employees close to retirement didn't have to participate, but it was true until 2022 that people close to retirement might have ended up having to pay in, but wouldn't have been able to benefit. And the legislature corrected that in 2022. But it works like Social Security or Medicare or paid leave. You pay in whenever you're working, you pay in a 0.5%, 0.58%, regardless of where you're working, when you're working, what age you are. Even if you go back to work when you're 80 and you would still pay in, it comes out of all W-2 wages. And then, but with a near retiree pathway, what's new is that for every year you pay in, you get 10% of the full benefit, which is a great deal for people because the typical worker pays in $290 a year. And for every year you pay in, you earn $3,650. So more than 10 times as much. So even if you work and even if you earn 4 or 5 times the median wage, you're still getting, twice as much back in benefits for near retirees. So it's a great deal for near retirees.
Thank you. Let's see. Just looking for a question we haven't answered yet. We've got a question from someone asking, do you see issues with telling people to have peace of mind about a fund they may or may not qualify for? I fear this will work against the hope of saving Medicaid dollars spent on long-term care services.
What was the second part of it again? About Medicaid?
It was, I fear that this will work against the hope of saving Medicaid dollars spent on long-term care services.
Well, so most people who pay into Walk Cares will qualify for benefits. The actuarial studies suggest that over time, more than 90% of people who pay in will qualify. The only gap right now in that is the portability aspect, but that's something the legislature knows about. It's on their radar, and they're working on it. Regarding Medicaid savings, the program will definitely prevent the need to raise taxes to pay for the long-term care costs associated with the age wave. The population 85 or older is doubling in the next 15 years in our state. And so right now we're spending 9% of our state budget on long-term care through Medicaid. If Walk Cares didn't exist, that could go up to 18%. Or to make that possible, sales taxes would have to go up starkly, markedly. Or other state spending would have to be cut dramatically. And so there was really kind of a tsunami coming at the state budget in this regard if Walk Cares hadn't been enacted. And so we're going to have Medicaid savings for sure, but to the extent that some small amount of people pay in but don't actually claim benefits, I guess that does reduce the Medicaid savings somewhat. But that over time, the vast majority of people who pay in will be able to get benefits.
Yeah. We've got someone asking to confirm that there is no maximum wage cap. Confirmed. And we have someone asking, what about volunteer firefighters who are paid once a year? How will this work for them?
It's a different one than usual. So if they currently pay into paid family and medical leave and are included in the wage report and premium payment for that, they would likely be included for Walk Cares as well. But certainly a question our customer care team can answer for you.
Thank you.
I believe we put the number for the care team in the chat.
It is in the chat, and it will be available on the slide that we put up at the end of the webinar as well. Let's see here. We have someone asking if there's a certain number of time that a worker needs to be no longer working before being able to apply for a benefit. For example, our long-term disability plan says that you have to be out for a certain number of days prior to being eligible.
No, there's nothing like that for this. This is if you need care, at any age above age 18, you're eligible as long as you need. So basically, to determine whether you get benefits, there's two steps to it. One is we check with our colleagues at the Employment Security Department if you've paid in a sufficient number of years to meet one of the pathways. And the second is if that's a yes to the first part, then we would send out someone to your home to do an assessment to see if you actually need care to live independently. And if you do need care, then you would be approved for benefits. There's no waiting period and after you stop working or something like that.
Thank you. Let's see.
These are really good questions, by the way.
Absolutely. And then we have someone asking, if my employer doesn't deduct my contributions, what happens then?
There's a couple of different ways to answer that or to take the question, I guess. So we do have a pathway that if you believe that your employer should be deducting the premium and they're not, you can call our customer care team. We do have an employer reporting and compliance team, and we look into situations where employers might need some additional guidance to be able to fulfill their responsibilities. If the question is about whether that would impact the eligibility for benefits down the line, you know, when we ESD hear about employers who may not be withholding the premium or reporting appropriately, we do, you know, go ahead and reach out and try to get that situation rectified. So I would think that if you let us know that that's something that's happening, we could make sure that our records are accurate so that you'd be eligible for the benefit were you to need it.
Thank you. We've got a couple people asking again about if an employee lives and works remotely entirely out of state, but the company is here in Washington, are they automatically exempt or do they need to apply for an exemption?
If they can apply for an exemption, certainly. If their work is localized to Washington, they would be included, but if they live in out of state, they can apply for an out of state exemption.
And it sounds like, though, these folks are asking about completely remote workers whose work is not localized in Washington. Do those workers need to apply for an exemption?
Their work is not localized to Washington, then you would not need to, they would not need to apply for an exemption.
Correct. Thank you. Okay. And we have someone asking, are benefits replenished, or they do benefit? Is there more of a benefit amount available if you receive long-term care benefits and then go back to work and continue contributing?
No, it's a lifetime maximum benefit. Keep the premium low. It was important to have a lifetime maximum benefit.
Thank you. And we've got someone asking, is there a paper form for employees who qualify for an exemption to fill out, or do they have to do it online?
There's a couple of different options. We do have paper forms available, particularly for folks who may have language barriers or need translation services, folks who need accommodations of other kinds. And we can walk people through doing it online. So if it's not, there are situations where there's a language barrier or a lack of access to technology. And we do have paper forms for those purposes. If it's just that online's a little tricky, we can certainly walk people through that process and make sure that they're able to submit online.
Thank you. And we've got someone asking, can we speak about how the self-employed process works? And is it anyone who is self-employed? What about their spouses?
So self-employed folks can elect coverage for WellCares. That will be in effect July 1st. We actually just did the release of that technology last night, and it was successful. It won't be turned on until July 1st, but it will be there. And it is for people who need to elect coverage for themselves as an individual. And so not quite sure if the instructions to do that are online yet, but they will be. As I said, elective coverage becomes available July 1st.
Thank you.
Right, and that should be at the wellcaresfund.wa.gov website. What is the page, Kristen?
It is /opt-in, and I can drop that in the chat.
Yes, and so spouses, so this is an individual earned benefit, so spouses are not covered unless they're also working and paying in and earning benefits.
Thank you. And we've got someone asking for clarification. If 90% of those who pay in qualify, how can you expect the fund to be solvent? So then can you address the solvency issue?
Sure. So 90%, so roughly 92% of people are expected to qualify in terms of having paid insufficiently. Then the next question is, only 7 in 10 people need long-term care. Not everyone needs long-term care. So of those 92%, 7 in 10 will need long-term care. It's like fire insurance. Not every house burns down, right? And so if every house burned down, fire insurance would cost a lot more than it does, because not everyone. So the magic of insurance is that it wouldn't be efficient for us all to save individually for long-term care, because I might need $100,000 of long-term care. Kristen might need $30,000 of long-term care, and Allison might not need any long-term care, right? So if each of us tried to save the right amount, we have no idea what the right amount of individual savings is. But with insurance, you pay in, you have to save a lot less than $100,000. You contribute to a fund a small percent, and then you can get back a decent benefit. And the reason why the benefit is large compared to what you pay in is because not everyone uses it. So that's why it works, and that's why we're projected to be completely solvent to the end of the century, according to the state actuary.
Thank you. And we've got someone asking for a little bit more clarification on that point about paychecks given to the employee on or after July 1st. So they're saying our payroll runs from June 20th to July 3rd. How do we manage collecting premiums on only one of those days, or do we collect premiums for the entire pay period?
Mm-hmm. So premiums should be paid on wages premiums are assessed on wages at the time that those wages are paid. So it would be for the whole pay period.
All right. We've got someone asking, are all Washington employees on non-immigrant visas such as H-1B or F-1s eligible for that exemption, or does it depend?
We do have a list of the specific visa types, non-immigrant visa types that are eligible for the exemption. I believe that list is on the exemption page on the Walkers Fund website.
It is, and I am dropping the link to that in the chat for folks to look at. Okay. And we've got someone asking when benefits become available.
Benefits become available July 1st, 2026.
Thank you. And if someone receives an exemption, either private insurance or one of the other exemption groups, is there a way to opt in at a later time if you want to choose to do so?
At this time, only for the 3 conditional exemption types. So that would be the non-immigrant work visa, the spouse or domestic partner of military member, and the out-of-state resident. The other 2 at this time are permanent.
That's true. And it's also true that our oversight body, the LTSS Trust Commission, recommended to the legislature giving people who got an exemption based on having private long-term care insurance, giving them the chance to come back in anytime over the next 5 years. That again, the legislature didn't open the statute this past session, but they might take that up in the future and give people a chance to join WACARES and rescind their exemption. But under current law, that's not possible. If you have an exemption, a private insurance exemption, it's permanent.
Thank you.
Again, these are all issues. Sorry, Kristen, if you have feedback, share it with your legislator on any of these issues. There's a process. The reason we have the LTSS Trust Commission, one of the main reasons it's there is to collect feedback from the public, and you can send feedback to us, or you can send it to your legislator. And this program, every year the commission makes recommendations to the legislature to improve the program in various ways. For example, the near retiree pathway was a recommendation of the commission. The exemptions for out-of-state workers was a recommendation of the commission. So if you have feedback on the program design, I would encourage you just to share it with your local legislator.
Thank you. And we've got several people asking about the definition of localization. I'm looking to see if we can grab a link to that on the website to drop in chat. Alison, do you have a summary that you can give? I know it's pretty complicated.
It is. I do have a link to the Paid Family and Medical Leave website. We do have an explanation there, and we can make sure that we get that cross-posted to the WACARES website if it's not there yet. Ultimately, we use the same localization standards as the federal unemployment insurance program. So if an employee lives out of state, but they work entirely in Washington, their work is localized to Washington. If an employee lives in Washington, but their work is performed entirely out of state, their work is localized out of state. And if an employee's work cannot be localized to a single state because they work in multiple states, then you can use the location of the employee's base of operations. So it is quite complicated. We, in fact, have a flow chart that our staff use to kind of walk through questions to ask employers about a particular circumstance. And so I can get the link to the information. We can make sure it's on the WalkCare's website, but ultimately calling our customer care team is probably a great option.
Thank you. We've got someone asking for clarification on calculating the 0.58%, whether that's on income from paychecks or adjusted gross income at the end of the year. So if you can address that, Alison.
It's on gross wages. So there's the definition of gross wages and a calculator to determine the premium are on the website.
Thank you. Yeah, that calculator is a great tool.
When you say on the website, Alison, which page would that be?
I believe it's on the employer page on the WalkCare site, and for the more detailed information, I think links to the paid leave site, since the things are largely, the definitions and things are the same for both.
So walkcaresfund.wa.gov/employer, I guess, right? Yeah.
And we've got a couple of people asking about whether these links we're dropping in the chat are going to be included with the slides, and we'd be happy to add a slide at the end with kind of an appendix of where to find some of this information so that folks can go and take a look in more depth. Okay, let's see. Okay, I think we've answered most of the questions here. I know we've only got a couple minutes left. A couple other things that I want to go ahead and address. We've still got people asking about the recording. Again, that's going to be available on the GSI website and on our website at walkcaresfund.wa.gov/webinars. And that link is in your chat. I'm going to go ahead and put some information up on the screen as well. So this is available in the slides, available on our website. But if you need to reach out to us after this presentation, you can find our contact information here. We have an email form on our website that will route you to the appropriate agency to answer the questions that you have. We've also got these phone numbers. Make sure that you're checking which phone number you call, depending on what kinds of questions you have. We will also, for those of you who have submitted things in the Q&A, we'll be following up by email. So if you registered with your email and submitted a Q&A that we weren't able to get to about your specific situation, our customer care staff will be following up with you after the presentation, but you are also welcome to reach out to us using this information. And we are at 12 o'clock, so I am going to go ahead and close us out for this webinar. Thank you so much for joining us, and thank you to GSI for having us to speak to your audience. We really appreciate it, and have a great day, everyone.
Yes, thank you.